All right, today we're tackling a massive shakeup in India's income tax system. And believe me, this is something you're going to want to pay attention to because it could totally change how much tax you pay. Let's jump right in. This deep dive comes to you from Growth Search, where we bring you daily insights to help you grow. And today, growing means getting a handle on exactly how the new tax code for FY 2025-26 is going to affect your wallet. Now get this. What if I told you that you could earn almost 13 lakh rupees a year and pay absolutely zero in income tax? I know, it sounds kind of crazy, but with these new rules, it's a real possibility. And we're about to break down exactly how.
Yep, a big fat zero. For the financial year 2025-26, this new framework makes it totally possible for a whole lot of people to have zero tax liability. So the big question is, how on earth does that work?
Okay, let's start with the big picture. We're calling this first part the zero tax promise because we need to understand how this isn't some loophole, but actually a planned part of India's new tax landscape. You see, the foundation for all these changes is a huge shift away from tax laws that have been around for more than 60 years. This is not just a little tweak. It is a complete and total overhaul.
And this really shows you the scale of what's happening. The old, incredibly complex Income Tax Act of 1961 is out. It's being replaced by the new Income Tax Act of 2025. And the big goals? To make the whole process way simpler and create what the government is calling a trust-first system.
So here's maybe the most critical thing you need to remember. From now on, every single person is automatically put into the new tax regime. It's the new standard. You can still opt for the old way, but this new system is now the default path. All right, let's get into the nitty-gritty. How is your income actually taxed now? Well, it all comes down to decoding these brand new tax slabs.
So take a look at this new structure. You can see right away it's simpler. With wider brackets, there's no tax at all up to 4 lakh. After that, it's just 5% up to 8 lakh, and then 10% up to 12 lakh. And that top rate of 30%, it doesn't even kick in until your income is above 24 lakh. It's just cleaner.
Oh, and here's a really nice bonus, especially for all the salaried folks out there. The standard deduction, that flat amount you just get to subtract from your income, has been bumped up to a very helpful 75,000 rupees. So we have new slabs and a bigger deduction. But how does that add up to the zero tax promise? Well, there's one more piece to the puzzle. It's the secret weapon, the real magic ingredient here. And it's a little thing called Section 87A. So what is this rebate? It's not a deduction from your income. Think of it more like a gift card or a direct discount from the government that you apply to your final tax bill. So if your bill comes out to, say, 50,000 rupees, this rebate can literally just wipe it all away. Here's exactly how you get to zero in 4 easy steps. Let's say your taxable income is up to 12 lakh. First, you figure out your tax using those new slabs we just saw. That'll give you a tax bill of 60,000 rupees. Then you apply the full rebate from Section 87A, which is also $60,000. And boom, just like that, your final tax bill is zero. It's that straightforward. Okay, but I know what you're thinking. What if I earn just a little bit over 12 lakh? Am I going to get slammed with a huge tax bill? Well, no. The system has a built-in safety net for that exact scenario, and it's called marginal relief. It basically makes sure your tax doesn't jump up unfairly if you're just over the line. Now, these reforms aren't just a one-size-fits-all kind of deal. There are some specific changes for certain groups, so let's look at 2 important ones, an update for senior citizens and another for stock market investors. This is a huge, huge win for retirees. The limit for TDS, or tax deducted at source, on interest from bank deposits has been doubled. Banks used to start taking tax out after 50,000 in interest. Now that limit is 1 lakh. That means more cash in hand for our seniors all year round. Okay, switching gears to investors. Before we talk about what's changed, let's do a quick refresher on STT. It stands for Securities Transaction Tax, and it's basically a very small tax you pay every time you buy or sell securities on a stock exchange.
And here's the big change you need to know. For anyone who trades in what's known as FNO, or futures and options, that STT has now increased. The government has said the goal here is to help curb some of the more speculative, high-risk trading in the market.
Phew, okay, that was a lot of ground to cover. So let's bring it all home. What does all of this really mean for you? Let's boil it all down to the key takeaways you need to walk away with. Let's run through the highlights one last time. First, the new tax regime is your new default. The headline for a lot of people is that zero tax on income up to 12 lakh is now possible thanks to that powerful Section 87A rebate. The standard deduction is also higher at 75,000. For seniors, there's a welcome break on bank interest, and for F&O traders, you've got a slightly higher transaction tax to deal with. And all of this brings us to one final thought. The whole stated goal was to make things simpler, to build a trust-first system. But as we've seen, every change brings a new set of rules and new strategies. So the real question for you to think about is this. Is this really a simpler tax system, or is it just a brand new game with new rules we all have to master? Thanks for tuning in.